The Federal Reserve cutting rates again today, but also indicating it may be the last one for a while. Let's get to Steve Leisman with the latest on this. Steve.
Hey, Melissa, that's all, folks. Fed Chairman Jay Powell stepping to the podium today after the Fed cut rates for the third time this year and announced in no uncertain terms the Fed is on hold unless there is a material change to expectations.
So we think that the current stance of policy is likely to remain appropriate, as long as incoming information about the economy is broadly consistent with our outlook, which is a positive one of moderate economic growth, strong labor market, and inflation moving close to 2%.
The rate cut brings the Fed's overnight lending rate down to 1.5 to 1.75%. Trade concerns and global economic weakness were behind the cut this time, but Powell suggested the Fed had provided a lot of help to the economy already, and that seemed like enough for now. In its statement, the Fed dropping that critical phrase from prior announcement that it would, quote, act as appropriate. That had been the signal to markets that rate cuts were on the way. Instead, the Fed now says it will assess the appropriate path of the funds rate, and that means being on hold for a while now. What would it take, so, for the Fed to resume cutting? Powell said that economic data would have to come in much weaker than the Fed expects. And how about a hike? Powell said that's far off, too.
I think we would need to see a really significant move up in inflation that's persistent before we even consider raising rates to address inflation concerns.
Markets now see just a 20% chance of a rate cut in December, and they don't bake another cut in until March, and just barely at that. Melissa, here's a trivia question for you. You ready?
Yep.
Pressure's
What
on.
What was the funds rate expectation for 2020 this time last year?
Oh, for 2020.
For 2020.
Wow.
75?
It must be close to 3. What was it, Steve?
3.4.
Oh, wow.
Okay, so what is it now? Let's do some high-level math on national television here. And I know you're a Harvard person, so you'll do this
I wasn't
quickly.
a math person, but
I'm
sure,
just
yeah.
University of Buffalo, but, you know, let's see if we can do this, okay? So 3.4, and now we're at 1.62, which I think is like 1.78. So there's been 1.8% of relief.
Sure.
75 basis points come from actual cuts, but a percentage point coming off of the expectations for future rate cuts. So that's where sort of that's Powell's thinking right there, that we provided relief, we stopped reducing the balance sheet, and we got rid of the hikes we were going to give, and we cut rates.
I think that's a nice way of thinking about it, but a lot has changed also in the past year in terms of the data and economic expectations.
Yeah,
right?
and yada, yada, yada. We had a trade war, right? I mean,
minor details.
A minor detail.
Bricks
That's
bread, but
that's
you know,
true.
it's no biggie.
You know, that's a really good point, Melissa. And actually, Powell made a point about this, which is worth saying. He says, you know what, we have the same economic outcome that we projected, but we're only getting there with a much lower Fed funds rate. So that's really what he's saying. We've incorporated all of this global economic weakness and the trade war. Now he does still basically have this optimistic outlook on the economy, but only getting there through a much lower funds rate than they initially projected they would get there, which was a 2% growth rate.
Okay. Steve, thank you, as always.
Pleasure.
Steve Leisman coming to us from Washington, D.C. For more on the Fed decision today, let's bring in Ann Bartels, head of ETF strategy at Bank of America Merrill Lynch. Ann, welcome.
Thank you.
So we saw Fed funds futures go down in terms of the expectations for a December cut. Are you there? Do you think that there's only a 20% chance?
So our economists are there for this year. But they're still concerned that the economy can slow going into 2020. So we haven't taken another rate cut off the table. We still think that there's risk that you get a rate cut in the first quarter of 20.
So what's your expectation about global growth? Do you think that the rest of the world is bottoming and that provides some floor?
Well, we've been, the global economy's been slowing, the U.S. is slowing, but not enough to see a global recession. So we stay in that camp, is that we kind of like muddle our way through without seeing a major recession, right? There's some European economies that are on the verge of a recession, but we don't see any major global recession.
So if you see trouble ahead for the economy next year, your investing is, in terms of the sectors that you like, are cyclical. So how do you sort of navigate that? Are you in it for now?
So we still like cyclicals because we're not calling for a recession. We still think the Fed will remain very accommodative, and we think cyclicals that are attractive on terms of valuation, particularly the financials. We actually still really like the financials. We also cover ETFs. That's kind of one of my new roles at the bank. And one of the ways that you can do that is through the KBW B ETF, which covers the KBW bank. We still find them to be very attractive. They've got clean balance sheets. They're still attractive for dividend yields. So for the longer term investor, we think there's a risk reward that's positive, even if the economy slows down and even if the Fed cuts rates.
So the bond market, in terms of volatility, I mean, we saw 10-year yields in the course of a year go from 3.25% to 1.5%, back to 185, 147. Current levels now. There's the volatility in the bond market, which is significantly larger in terms of market cap than the equity market. Is that concerning at all? Because if you associated the same volatility in the equity market, we'd be having much different conversations, I think, on this desk every night.
We don't think people are talking enough about that subject. We wrote about it, the firm wrote about it, how the volatility in the bond market is very high. And if you look at risk-adjusted returns, the equity market right now looks looks a lot better than the bond market. What we're telling people is expect continued volatility in the bond market. We're still forecasting, our rate strategist still thinks that rates are going down, even though they've temporarily backed up in here, that the trend in rates are still lower.
Okay. Marianne, great to see you. Thank you so much.
Thank
Marianne
you.
Bartels, Bank of America, Merrill Lynch. What I thought was interesting was the equity markets were pretty stable throughout the press conference, but what we did see was we saw buying in the TLT. It was up 1.5%. What'd you make of that?
Well, it was interesting. So the yield curve flattened a bit, and essentially the Fed, who told you we're going to assess the appropriate path, was today's hawkishness. Dollar closed down at the 200-day, so the dollar weakened up and yields went down. It told you that the Fed is actually going to be more accommodative than you had thought.